alternate asset managers and figure out what he's making and what is it that he would advise market participants. Jitendra, hi, morning. You just heard A. Bala from Aditya Birla, and he was talking about as to how there are a lot of uncertainties out there. Tread with caution a little bit. Right now is not the time to get a little risk with your portfolio. What is your own recommendation or advice about, what the market construct is looking like and how investors should behave?
Hey, hi, good morning, and thank you for inviting me on your show. See, first of all, uncertainties are there, and we are going to see more such bouts of uncertainties, right from COVID to Ukraine war, then inflation, recession risk. I think last 5 years we have seen this heightened certain uncertainties. However, markets are making new highs because market loves fiscal and monetary expansion and loose monetary policies. Across the globe, I think most of the large economies are actually on a spending spree. Germany, which, for example, was championing austerity, now has started, talking about huge spending plan, and they are also going to expand their fiscal balance sheet. Similarly, inflation is much higher in developed markets, but still they are cutting rates. So what it shows that more the uncertainties, more efforts the policymakers are taking to prop up the economy, and that is actually leading to kind of an expectation that whatever it takes, governments, policymakers are going to avert slowdown and recession, and hence markets are actually buoyant. And if I see India, slightly it's behind the curve, or we have actually adopted more cautious policy, rightly so, because in case if global market starts to falter and we see more turmoil, then India has started to build a lot of buffers, right from corporate balance sheets to see current account deficits have started to come off. Inflation control has been pretty stark, and in fact, our inflation is below Japanese inflation. So India is actually charting its own territory where we are compromising a bit of a growth, but we are going for macro stability, macroeconomic stability, and that is leading to, I think, confidence in India's macro, which is at a very, very strong level compared to where the global economy is. However, if you want to translate this macro stability of India and global uncertainty into earnings, I think India is in a kind of a position where earnings growth is going to disappoint. Economy might do much better, macro stability is going to do much better, but in terms of earnings, I think we are going to see more disappointments going through. And why? Because I think we are going to see a lot of competitive intensity will pick up pace in virtually all the sectors, barring, I think, airline or to some extent auto. All other sectors we are seeing competitive intensity will go higher because the cost of borrowing, cost of capital is going to fall. ROEs are best in the world, margins are at all-time high. So all these factor points towards heightened competitive intensity across the sectors. And that's why I think going forward, earnings will not come through. More and more companies are going to venture into different segments, right from wires to paints to cement to consumer durables, consumer FMCG. So I think government is going to make ease of doing business is much, it's taking place. Transportation cost is falling, so cost of doing business is going to go down, and hence we think earnings will see a lot of disappointments. But macro parameters growth is expected to remain very robust in India. So that's the kind of situation we are into.
Hi Jitendra, morning. This is Shrishti also joining in. Yes, very interesting take that maybe earnings can disappoint, but the competitive intensity is expected to pick up. And we have seen that already, Jitendra, in sectors like the quick commerce space, beach diagnostics, and recently, like you mentioned, the wires and cables and even the paint sector. If we really need to look at these four sectors particularly, the first two, the companies are now seeing a bit of a rebound in terms of the stock price because the investors are digesting the fact that the leaders will make their place. But on the flip side, the sectors like cables and wires and paints, the companies are still, and the stock prices are still a little languishing in trade. Help us understand that if we have to really look out at these four sectors specifically, how should one approach the companies, and what really gives and brings back the investor confidence?
See, first of all, valuation, right? So everything needs to be priced perfectly. And in India, the problem is because these companies are showing exorbitant margins over the past 5 years. Margins have started expanding. ROEs are much better. Balance sheets are stronger. Uh, Valuations have gone off the roof, and that is leading to some kind of correction and disappointment. So there is very little headroom for these companies to disappoint. So smaller disappointments will lead to larger correction in prices. That is number one. Number two, we have to see that there are sectors opportunities are improving. So earlier, if I have to look at only investing, there are large sectors which are pretty much all bellwether sectors. But now I think new kind of sectors are emerging. So from investment perspective, there are other opportunities which are emerging. So I need not necessarily have to look at only the certain set of sectors, but for example, defense has seen significant traction. There are new companies got listed. Similarly, in waste management, in water management, now nuclear reactors, for example, is a new sector where private participation will open up. So I think investors, fund managers have a plethora of opportunities, not looking at only the traditional sectors, but now there are new sectors which have come up. In the auto sector as well, for example, we have seen new listings have started taking place. And hence, I think the opportunities are higher in, for example, in financialization of savings also, right? All the depositories, there we are seeing IPOs coming in. In asset management businesses, we have seen a lot of new companies have come up. So the not only from operational competitive intensity, but also from the investment opportunity front also, we are seeing a lot of opportunities are building up in various sectors. So the valuations should come down. And hence, I feel that the traditional sector should not be looked at from a traditional sense of valuations, but going ahead, we have to evaluate this competitive intensity. It's not that all companies are going to see valuation deterioration. If the companies are able to acquire businesses, turn it around, those kind of management capabilities that one needs to find in these kind of sectors, because the large companies that are sitting on huge cash piles now looking at investment revenues, and wherever they find ROEs are more than, let's say, 18-20%, growth is decent, reasonably high, margins are looking very strong, then these large companies are going to come and invade that businesses. And that's very clear. Going forward in the next 5 years, we think that competitive intensity will disrupt these kind of businesses. And hence, one has to be extremely careful investing in these sectors.
Good morning, Jitendra. While you say earnings growth is disappointing, I agree to that. But more than that, the FIs and their lack of conviction in the Indian markets is worrying us all. While the foreign institutional investors plan and strategize entering a market, they'll have a look at the economic indicators and sectors which are like the backbone of the economy, let's say banks and financials. While we see the earnings picture of the same, they are also not that so happening. A tricky one to answer, but when do we see an absolute comeback from the FIs, or we just have to see the DIs helping the markets?
There are two parts I've done. First is if you look at FIs, they generally look at the macro stability parameters first, right? So if I look at the rupee depreciation, which used to be 3%, 3.5%, 4%, now that rupee depreciation factor is somewhere around 1.5 to 2%. That means the required rate of return that they expect from India is coming down because the rupee is fairly stable, and probably that is because even the dollar is faltering. Not just India's fundamentals are very, very strong, but even dollar is faltering. So that's why I think there is some comfort for the FPIs that look going forward, rupee is going to remain largely stable compared to what rupee's trajectory was in the past. That is one aspect. The second aspect, FPIs have sold in the past 12 months. But if I look at from, let's say, March onwards, we have seen March to June, FPIs were net buyers of Indian equities. right? And July, we have seen a pretty flattish kind of movement from FPIs. But if I look at last 12 months, FPIs generally sold, but that's in line with what happened in the other emerging markets. So FPIs have sold virtually all the emerging market, countries, and India is no exception. So despite, I think, just looking at FPI outflows, I think that's across the emerging market basket and not just in India. Now, the answer is going forward, what is going to happen? So first is now FPI holding of Indian equities are down to almost 16, 17%, I think in that range, probably in that range, not sure the exact number, but it is at a multi-decade low, right? And DIs have actually surpassed FPI ownership in BSE 500. So that means India has started to build a lot of resilience as the economy moves from 4 trillion to 7 trillion. Similarly, the market cap of India is also going to go higher. So as the market cap grows to, let's say, 7 trillion, 10 trillion over the next 5, 7 years, then we might see the depth and breadth of Indian markets are going to be better. The other point that one has to also understand is that while the promoters are selling Indian equities, so BSE 500 ownership of promoter is slowly declining. That is also leading to better free float. And better free float, that means India's weight in emerging market index is going to be higher. So net, I think from a longer term perspective, India's resilience has improved. India's macro parameters, macro resilience in terms of dollar, interest rate, inflation is very much comforting. Now, the last question is valuation. Now, this is a problem. Compared to other emerging market, India remains a very, very expensive market, and that actually puts down the FPI. So whenever there is large corrections, I think FPIs are going to look at India, but not currently. I think they are sitting on the fence, thinking India is expensive, growth is not coming, so they are in a wait and watch mode. But as we see that there is correction and we see some kind of valuation comfort, then you will see that FPI inflows will come back to India. But at least compared to last 1 year, at least FPI outflows have abated, and this is a positive sign.
Right. Okay. Great to have you then on the show today. Thank you so much for your time and speaking with us with your views.
Thank you. I appreciate it.